Hi, I'm Jesse Jones, founder of Fourscore Business Law. Thanks for tuning into this quick video on how to structure an equity deal. We're going to go over three important terms that you're going to see in a venture term sheet: protective provisions, liquidation preferences, and participating preferred stock. Protective provisions are provisions that will be placed in the amended and restated charter and will give investors certain consent rights over certain things that the company might want to do. It could be the investors themselves as a subset of the shareholders that have to give consent, or it could be the investor board member if the investors are going to put a director on the board of the company in connection with the financing. But protective provisions give consent rights to the investors over things like executive pay, increasing the stock option pool, selling additional shares of stock, that type of thing. Liquidation preferences, this is a very important right, probably one of the most important things that investors are going to ask for in an equity deal. A liquidation preference allows the investor to get their money out of the company before the founders do. So when the company is sold, there's going to be a pot of money that's going to be divided up among the shareholders. The liquidation preference, however, will say that the investors get paid out first. So that goes hand in hand with participating versus non-participating preferred stock, which is what we're going to talk about next. So participating preferred stock would say that the investors are going to get their money back, their initial money back, plus they're going to share with the common stockholders pro rata. That's pretty uncommon. You'll see it in later stage deals, but in early stage seed and Series A deals, that's not normal. It's unusual, but it is there. Non-participating preferred stock, now that is sort of more normal. And what that says is, in conjunction with the liquidation preference, the investors get to decide. They either get their money back, they get their preference, and their preference could be it's normally 1 times their money, so they get their money back. It could be 2 times, it could be 3 times, whatever. That could be a negotiating point, but most commonly you're going to see a 1x liquidation preference. Non-participating preferred stock says that the investors choose. They either get their money back or they get to share with the common stockholders pro rata. So if the company is sold and the share price is not enough to make a good return for the investors, they're going to take their money back. However, if it's a great return, they'd be better off sharing pro rata, and so that's what they'll choose. For more information on how to structure an equity deal, check out the venture white paper at fourscorelaw.com. Thanks.